All right. Good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner, and we are live. So, we are talking today about family banking. And the reason that this particular topic is so near and dear to our heart is that this is more than just using infinite banking. This is really a strategy of using infinite banking for the purpose of developing family capital and developing a family with capital and resources to be able to invest in the family members and to be able to create generational wealth and a growing asset that can continue to fund and build a foundation for wealth in your family for generations to come. So today we're talking about how and why somebody would use family banking, what it is and what it does. And especially if you're coming to this conversation today with no prior history or knowledge of us and the work that we do, and you've just heard this topic of family banking, it's maybe been on your radar at some point, you're interested in this idea of having a banking system that your family is using to be able to take over the banking function in your life and really have this financial leverage and this tool that sets you ahead. We're here to talk to you today and help you be able to get the grounding and the framework and the foundation to be able to start to take action steps in your life so that you can take advantage of this powerful tool. Bruce, I'm really excited to talk with you about this today. Thank you for joining me.
Yeah, that's great. This is, I guess, one of the things I think that behavior is more important than structure. It's more important than processes. And I think a lot of times we overlook that because the thing that people can hang their hat on and say, oh, I need to do this, this, and this. And it's great to map that all out, but unless you actually do it, it's not very useful. And I think it was about 2016 when I did a talk at the Nelson Nash Institute, and the title was How to Make Infinite Banking Infinite. And it actually talked about the processes, not only for the families, but also for the whoever you work with. They absolutely would have to have processes or succession plans in place because obviously the agent won't be around infinitely either. And so that's why it's really important that you work with somebody from the Nelson Nash Institute as an authorized practitioner for a couple of reasons. Is then you would know that um, even if they don't have a succession plan in place, and not everybody can have a successful succession plan in place because they might be a sole practitioner, but at least you could turn to the Nelson Nash Institute and then find somebody that has the same mindset so that this can become infinite from one generation to another.
Absolutely. And I'm going to make a quick plug here. I am also now an authorized IBC practitioner or infinite banking concept practitioner with the Nelson Nash Institute. And I'm really excited to be able to use that knowledge and use my understanding of infinite banking to continue to educate you and to continue to grow my knowledge. The most important thing about understanding any tool and using it well is to recognize that we're all continually learning and there's always more to understand about something. And so I am on that same journey along with you to continue to grow my knowledge and be in a position of really understanding the intricacies and the inner workings of why and how infinite banking works. So we're going to be able to bring that into the conversation today. And I want to really just start with this idea that infinite banking is straightforward. It's really simple. And today we're going to be talking about the process of banking and why you would be interested in being a banker yourself and in your family and what that allows you to be able to do. And so I really want to start with this concept that it's very simple. It's a simple process of banking that we're going to be able to discuss today. But I think the challenge with any new idea or new strategy or financial concept is sometimes it can feel like it's very foreign or it can feel really complex, really convoluted. And our job is to make it simple for you. And the reason it's our job to make it simple is that we want you to be able to take action on things that will really truly benefit you. And deep understanding is important, but even more important than a deep technical understanding of something is your ability to have a framework to think clearly and be able to make decisions. And so It's straightforward, and we're going to be able to do that today. If you have any questions as we're jumping in, I would love to hear you drop those questions in the chat. It can be as simple as, why would you do family banking? What is banking? What is infinite banking? It can be anything about any comment that we say today during the show, but we really want to be able to help set you on a trajectory to have financial advantage in your family. So not only is it simple, but we're going to help you think about what are these family banking structures, what a strategy for family banking is, and really help you to manage wealth effectively. The point of family banking is to be able to access liquidity and capital. And so we're going to discuss that today. We're going to show how it helps you earn better returns, how it helps you make more informed financial decisions. You reduce taxes. You can achieve this durable financial independence that you can start today in your family and continue on through your family line. And that allows you to help leave a lasting legacy. So some other additional pieces of this are that it's going to help you eliminate financial anxiety, eliminate market risk or reduce market risk, reduce high banking fees, and really overcome the complexities of financial planning. So I'm coming back to that same idea that this is simple. Often finance and money and making financial decisions can be really complicated, and we instead are going to help you have a formula and a framework to be able to make simple decisions because you understand the lay of the land and the whole economic ecosystem and atmosphere that you live in. And so really being able to secure your family's financial future. So Bruce, as we jump in, I think it's really important to note that this is not a new idea. Families like the Rockefellers, the Kennedys have been using family banking for a long time. Very wealthy individuals for centuries have been using specially designed whole life insurance as a tool to be able to store capital and then be able to access and use that capital. And so I just want to point out that this is A, not a new strategy. B, it has very much benefited some of the most successful and wealthy families throughout history.
Yeah, so let me start by actually using a comparison that I think everybody already understands. And then we can compare it to what we're going to be talking about today. So I think everybody at least has a hint that some of the most well-off people in the world, especially in the United States, because we have such great property rights, are people that have obtained real estate. Okay, so real estate's an asset. And what you do with assets, that particular real estate, you actually obtain it, usually using leverage, and then you pay the loan down. And while you're paying the loan down, you actually are building equity by paying down the principal, but at the same time, that real estate appreciates in value. So when you think of a whole life insurance contract as being an asset that you're paying down and you're gaining equity in it, and then through the dividends and interest that you're gaining, it actually appreciates in value. And then through the death benefit passed along to the next generation, it actually leverages up and appreciates in value again. Now let's talk to all of our current real estate developers that are listening. A lot of times a real estate person will buy a piece of real estate, they will fix it up, or they will wait for it to appreciate in value, and they're paying down the mortgage at the time. They will then refinance it. They will pull out the equity and buy another piece of real estate. And they will keep repeating that over and over until they amass several pieces of real estate. When they die, then they actually pass that real estate on to the next generation in many cases. And that gets passed along. And under current tax law, there's a step up in cost basis. So there's no change in the taxes. And then they would hold it and do the same thing, harvest the equity, get more pieces of real estate, and then a lot of times even borrow against those for their everyday activities. They will get loans that are not taxable. And then they will pass that along and the loans will get paid off at their death. And so this continues to happen. And this is how real estate empires are built. And if you think of whole life insurance the same way, where the first generation actually would start a whole life insurance contract, they will be paying for the contract just like a piece of real estate. It will be gaining equity by paying the contract down, gaining equity by paying down the principal. Then they will average it will actually go up in value from the dividends and interest, and then it will accelerate on the leverage portion through the tax-free death benefit. And then there has to be a place to receive that tax-free death benefit, which would be the next generation that should already have life insurance contracts that can receive this. I've told this story before that David Stearns, Nelson Nash's son-in-law, was really nervous because Nelson always says, "Do not steal the peas," which is a story that he says when you take loans from your life insurance contracts, that you need to have a plan to pay it back. And David Stearns had bought, and he and his wife Kim, who's Nelson's daughter, bought Nelson's home, which was Kim's childhood home, and they had completely remodeled it and had $500,000 worth of loans in against their life insurance policies. Once again, that's kind of nice, isn't it? They had $500,000 capital that they could have a loan right away. And then Nelson came to him and said, "I'm not doing well. I want to know if you have any room in your policies to accept my death benefit." And David said he was real nervous because he was afraid Nelson was going to be upset with him for having $500,000 of loans out. And he said, "Yes, we have $500,000 of loans, and then we have some other convertible term." And Nelson's response was, "Good, because this was going to be a place to store some of the death benefit that Nelson was going to pass down to the next generation." So do not overcomplicate this. If you compare it to real estate and you have a good idea of how real estate, and most people do because most people own a home or they are paying off a home. If you compare that asset to whole life insurance contract, that's another asset. This can be passed along from generation to generation.
Bruce, I love many things about what you just shared. And one of them is that life insurance is very similar to real estate capital, real estate equity, a real estate portfolio that is growing, where you have growing equity, growing assets, building more properties, and then having a mechanism to pass that on to the next generation. Life insurance can do the same thing. And what I love about your example is that that requires a concept that it is good to build up a financial portfolio and use that to infuse capital into generation two, so that generation two can continue expanding that capital and infuse that capital into generation three. So at the forefront of the idea of family banking is that it is good to leave an inheritance. It is good to pass down wealth to the next generation. It is good to expand your financial territory, if you will, and to be able to bless your children and allow your children to be able to bless your grandchildren. And the reason that this is so important is that you have the capability to not just build up assets for yourself, have them be evaporated through tax, eaten up when you need long-term care so that you can get Medicaid. There's so much that can just take away the wealth that somebody builds in one generation and leaves nothing to generation two. Instead, we have the ability to create generational wealth. And why is generational wealth even an advantage or a value? If you have properly trained your children and if they have good financial sense and they're making good financial decisions and they have the right training and the tools and the knowledge of what to do with money when it comes to them, then they're able to use that to continue to build and advance and set their children and grandchildren ahead of where they started. And that's how wealthy families stay wealthy throughout generations. That's why when you hear families like the Rockefellers, like the Rothschilds, like the Kennedys, you see families that have continued to expand their financial reach or their scope within each generation. It's not just something that there was one wealthy individual and then that money was all gone in generation two. And so if we can all aspire then to create this path of increasing capital in future generations, then the next question is, well, how do I best do that? And so I guess, Bruce, really what I wanted to just point out is that it's really important to first adopt that mindset that I want to create more opportunity and more financial stability and more chances for the next generation to be successful, not having to start over. So that is a mindset that's required in order to first make this work. But then the second piece really that you were saying, Bruce, that you're building up this capital, you're building up equity, you're having an increasing net worth that then is able to begin building equity in the next generation. That's exactly what we're doing with whole life insurance. And so at the forefront of the family banking idea, this is something we talk about when we introduce the infinite banking concept all the time. There is a banking system that is operating all around us, and we're often unaware. We're in this environment, we're breathing this air of a banking function all around us without recognizing its power. So I want to just make you aware of that for one moment. You have money flowing into your life through whatever it is, your job, your income, maybe pensions, you might even have social security income, you might have businesses that are paying capital, you might have investments, but you can think of your personal household economy as all of the money that's coming in. Then you have money that's being dispersed. So that is going to your expenses. It's paying for your home, it's paying for your lifestyle, it's paying for your cars, it's paying for your kids' education. All of the expenses that you have, that's money flowing out of your hands or your personal economy. But that money is going somewhere and it's being held somewhere while you're using it. And that is the process of banking. So right now, we are typically holding our capital while we're using it and before and after we use it in a banking institution, which is usually the bank, the brick and mortar banking place on the corner that is, I mean, you can imagine all the names: Wells Fargo, Bank of America. It's all of the big banks and small banks, local banks. We're storing capital in banks. There's not a problem with banking, but what happens with banking is wherever capital is being stored, the organization or the entity that's in charge of holding that capital now has the advantage of having that liquidity because they can send that cash out at interest and receive interest payments back to them. They can invest because they have capital. The question is then, if money has to be stored somewhere, and whoever is storing that cash has the advantage of being able to make more money because they have cash, why can't we do that in our own life? Why can't we be the ones who hold the capital so that we have the advantage of being able to use that capital, deploy it, and have it returned to us at interest and bring back greater returns? So I see Becca Wilhite, she's part of our team and she's listening right now, and she's written a book called Beaver Bankers. And I don't have it right in front of me. My daughter was reading it last night and showed it to me this morning, so it's fresh on my mind. There's an idea that a beaver creates an ecosystem by damming up the water and creating this entire environment that serves their habitat. We as well can be like that, where we create an entire habitat by directing and redirecting the flow of money that's going in and out of our personal economy and our personal ecosystem so that we can create a reservoir. We can be in charge of that banking function. We can store capital. And because we store capital, we can be in a position of opportunity. That benefits your family because you now have capital to be able to invest in the family members, the true wealth of your family, the social, the personal, the relational capital. You're developing the family members and you're allowing the people of the family to be able to thrive and flourish. And so having this store of capital in your family then allows you to be able to send that money into your family members for their investments, for their development, and have money return back into the ecosystem of the family. And as you do that, you have this thriving, growing pool of capital that you can borrow against, you can send money out, you can have it return back into this ecosystem. And because of doing that, you have the advantage of uninterrupted compound growth, and you have the ability to continue building equity and building this death benefit that can then turn over in a future generation and continue to grow the banking resources, the ability for more capital to be preserved and stored within the family.
Yeah, a couple of things that come up oftentimes, whether it's social media or people that actually engage us and talk about this type of concept, is one of the first things they say is, "Yeah, okay, you said the Rothschilds, you said the Vanderbilts, um,
I didn't say the Vanderbilts because they did not keep money well.
but
I
they
said the
start, but
Rothschilds, they started well.
they started to, but then they did not take care of it, and that
Hmm.
shows once again behavior
Yes.
uh, has. But what my point is that they talk about these other high net worth people that do it, but nobody does this anymore. Well, that's actually not true. If you actually work with high net worth individuals, almost without exception, high net worth individuals use permanent life insurance, and they use it for a variety of reasons. One, they'll use it for a creditor protection. Two, they'll use it as a pool of money, and you can see many things in history. Pampered Chef, the Walt Disney have used these to actually build businesses. But we are currently working with a family. The brother's worth $65 million. I think that's high net worth. And his younger brother is worth $12 million, and they are currently working with us to devise a plan so that the the older brother will be able to pass down a majority of his net worth in a death benefit. And
Mm.
one, it will actually the leveraged up death benefit of the life insurance death benefit will actually be put into a trust, irrevocable trust, and it will actually not be part of his estate. And that way, he will use that to then pay the estate taxes. So that's one way that life insurance actually helps not deteriorate the net worth. And I'm telling you, every high net worth individual that has any kind of advisor actually uses a similar strategy. And then the younger brother is actually using that that situation, that he has policies that can accept that when his brother passes away. Now, they are thinking about generational, because the his older brother's actually thinking about his brother's grandchildren because he doesn't have any children. So he's thinking about, how can I get this to my brother's uh, children, his nieces and nephews. And so it's a very, very common strategy. People just want to say nobody does it because they want you to do something else. So just remember that. The other thing I think that comes up all the time is they say, "Oh, this is a poor place to put your money because you don't get any rates of return, and or it's a low rate of return." Now, let's just think about this. People are storing money in banks. The last time I checked, it was $17 trillion in banks, and that was before we had the increase in interest rates. So they were basically making nothing, but they were still storing $17 trillion in banks. Now, all we're asking you to do is change one thing you're doing. Instead of storing the majority of money in the bank, is to store it in another financial institution, which is a mutual life insurance company that's participating. And that participating means you're going to receive dividends and you're part owner of the company. That's the only thing we're asking you to do different. And then another person might say to you, "Yeah, but I don't have total liquidity." And total liquidity, I say to people, "Well, are you going to spend all the money that's in the bank anyway?" Because most of the time people say, "No, I don't. I get nervous when it gets below a certain level." And I say, "Well, okay, well, then you really don't need total liquidity." And the final thing I mention to people is, when you don't have total liquidity, you must get a premium for that, because we talk about safety, liquidity, and growth. You can't get all three of those. So if you lack some liquidity, you better get some other things for that lack of liquidity. And what do you get? You get a variety of things. You get tax deferred growth that you can access tax free. You get a leveraged up death benefit. You get a terminal accelerated terminal life insurance so that you can actually use if you get terminal illness. You get long-term care and chronic illness with this. You get ability to borrow against your cash value on a strike of the pen, one signature. You get favorable payback terms that you determine. So you do get something for that lack of liquidity. What do you get for the liquidity in the bank? Well, yes, you get liquidity. Do you get growth? No. Do you get safety? Some people say, well, yeah, I get safety because I get $250,000 of FDIC insurance. That's true, but you don't get creditor protection in the bank. Matter of fact, that's the worst place to have money for creditor protection is in the bank. It'd be better if it was in a retirement account or in your house or somewhere else. It's the worst place. So you have to get premium for something. So when you take all those things in consideration, all we're really doing is asking you to change one thing in your life. And that is just to, instead of storing the majority of your money in a bank, store it in another financial institution, which is a life insurance company. And then you will get the benefits, all the benefits we talked about. And those benefits will enhance generation after generation after generation.
Bruce, I think a few additional things that are important for somebody to think about as they're conceptualizing this idea of not just storing capital in a regular bank, but using holding capital within their family. That's one step, right? And then they're thinking about all these advantages that they can have and why would I store it in this banking system of using a whole life insurance policy? How is that different than putting money in the bank? And you've covered a lot of the attributes of why it's so different. But I think one of the important things to note is that when you're putting money into a banking system, a family banking system, using a specially designed whole life insurance policy, you're getting all those advantages. Part of the reason that you're getting that is because inside the life insurance company, they are holding dollar for dollar reserves, meaning when they have a dollar pledged to be paid through cash value or through death benefit, they have $1 that they're holding inside of the life insurance company. A bank does not do that. A bank has $1 for every 10 that is pledged out to the depositors. So that's one difference that you see between a life insurance company and the banking system. Does that create more safety and more access to your capital and more confidence that your money will be there when you need to access it from the life insurance company? I think so. I'm not going to say that it is safer than a bank, but could it be safer than a bank? I think it could be. When you then look at the idea of, you mentioned, Bruce, that you are a policy owner. You were an owner with a life insurance company, whereas at the bank, if you put your money in a savings account, you were a customer of the bank. Let's just clarify what the difference of that provides to you. When you are a customer of the bank, you are getting paid maybe a tiny little bit of interest to hold your money in their institution. They're paying you because it is their advantage to be able to have your cash. But when you're in the when you're using a life insurance company to store your own capital, it's different than saying, I'm just putting this money at the life insurance company, because contractually, the life insurance company provides you the accessibility to your cash value on a guaranteed basis. That means that if you have capital stored at the life insurance company, you will be able to access your cash value. And because of that, you are an owner at this bank. If you're working with a mutual company, you're an owner of this policy that you're holding. As an owner, you get paid dividends and interest. So what does that mean? Well, I'm getting paid interest, which is a guaranteed growth of my cash value. In addition, when the company is profitable, when the insurance company is profitable, they're paying me out dividends because I am an owner and I'm holding my capital at that organization. I'm using the life insurance company to be able to create my own bank that I control because I'm building up a business, I'm building up a profit producing machine that pays me interest and dividends, whereas I don't have that opportunity when I'm a customer of the bank. Bruce, is there anything else that we can use to clarify that difference? Why is it that I become an owner? Why do I have so many advantages using a life insurance company versus using the regular banking system?
Well, I mean, just to clarify a couple things. Um, the problem with the problem with fractional reserve banking, which you talked about, is you could have a run on the bank when people get nervous because they want to go get their money out because they feel like the bank's failing. And the FDIC insurance tries to accommodate that and give people some faith that it's not going to happen, although it still happens. With an insurance company, just to clarify this, because I don't think a lot of insurance agents even know this. So if there are a lot of insurance agents don't know this, probably the general public doesn't know this. Can there be a run on the insurance company? Absolutely, there can be. In other words, people could say, oh, I think the entire insurance industry is going to fail. They generally do not do that because there is the one-to-one relationship with that money being there. However, if a lot of people want the money out of the insurance because they can't get their money out of the bank or they need it for other reasons, the insurance company can do the same thing as the bank can do it, and they can delay you taking money out of the bank. So you're not 100% sure that you can get the money from the insurance company. I just want to make sure people are 100% because I can hear some people out there that actually know and say, well, no, insurance companies can, they, they can't, they can actually stop you from getting it, which is true. The likelihood of that happening is not that great, but it can happen. It's in the contract. And you actually would want that, right? Because you would want them to be solid in that situation, but it's probably not going to happen. So I wanted to clarify the differences between the two. There's much more likely to be a run on the bank because of that, because a lot of people know that the banking institution is teetering because they hear of all these banks failing. When was the last time you heard of an insurance company failing? Well, you haven't heard of it because insurance companies take care of each other and they actually can purchase the contracts on pennies on a dollar. And there also is the state's guarantee that you pay into, which is much like
The
the
FDIC.
FDIC insurance.
Hmm.
So a lot of people don't know that either. So I just wanted to declare. You asked me for some things that are kind of similar or additional things that people might not know about, and those are the things. Now, also, I want to clarify that, and you said this already, dividends are not guaranteed, but they are highly anticipated. And the reason they're highly anticipated is because of all those guarantees and conservative nature of the insurance companies, and they cannot make money out of thin air. And so, because of all those things, every insurance company that we work with have been paying out dividends for 120 plus years without interruption through the Great Depression, through World War One, through World War Two, through all the world wars, and through the Great Recession of 2008-9. So those are some other characteristics I think people need to be aware of.
Yes. So the idea that you're able to become a banker within your family by using a specially designed life insurance contract really rests on this ability to recognize that you're not just getting paid interest, as in putting your money in a bank, but instead of just getting paid interest over here by using the regular banking system, you instead are guaranteeing that you have access to this capital through policy loans. You can also withdraw your cash, but really the advantage for you as a person who's using a life insurance policy is that you can access your cash value via policy loans. It's a contractual right and ability to do so. And you have control because you can repay that loan at your terms. So on the timing and the schedule that you set with the interest that is charged to the life insurance company. So the reason that you are being your own banker when you're using a life insurance policy, though, is that you're getting all these advantages. You're being able to grow this capital at a much faster rate. You're in a position where you're having the interest payments adding to your cash value. You have the dividends that are not guaranteed but are highly anticipated adding to the cash value. You have the access to the cash value through policy loans. You don't interrupt the compounding when you do borrow against your cash value. and you can repay on your own terms. You have also, in addition, this growing death benefit. So all of those things are showing that you have the ability then to continue earning and growing this pile of cash within the life insurance policy much differently than you're growing a savings account at a bank. So,
Yeah, go ahead,
yeah,
Rachel.
so I think the number one thing I guess in the back of my mind is, well, to become my own banker, why am I becoming my own banker when I use a life insurance company versus just putting my money in the bank? And I think the main thing is that you are continuing to grow wealth. I need to be able to communicate this really clearly. You're continuing to grow wealth when you put money in an insurance company, because when you access and use your capital, you're not interrupting the compounding, which means you have the ability for your cash value to continue that uninterrupted compound growth curve, which is an exponential curve. And as you're continuing to grow that capital, you can use it all along the way, but it's continuing to grow. Instead, when you're putting money into the bank and you're taking it out and you're putting money in and taking it out, you're never actually rising over that compound interest growth curve, because you're resetting the compounding every time you withdraw the capital. I think that's probably one of the main reasons why you have so much of an advantage when you're using a whole life insurance policy. Go ahead, Bruce.
Well, I was just going to say Warren Barnes, who's a longtime listener, and he just wants to clarify. And I agree with him. This is an actuarial, but it's hard for people to really understand. It's the reserves are not exactly one to one. They're holding the reserves that are a portion of the future death benefit, but because the actuaries know that not everybody's going to die at the same time, they know they do not have to hold the exact amount of reserves because they're promised a future death benefit. And so, just to clarify that, I think Warren, that was a very good point to make sure people understood it. The actuarial science is well above most people. I know it's not above Warren because he's a very highly trained CPA that has worked for some insurance companies. So thank you for clarifying that, Warren. And the other thing, there are other characteristics I think people really ought to consider is the characteristic, as this one Muhammad David mentioned. He says, people are stupid. I don't know if I'd be that harsh about it, but I do think people are ignorant, which I think is a different thing. Ignorant means you don't know. But think about this as, what other assets are there? Well, let's use a family business. That's an asset. It gets passed along to the next generation. And what happens often is that the next generation either doesn't want to run it properly, or they want to run it properly, but they don't have the same kind of commitment as the first generation. And that business actually fails and that asset actually shrivels up. Or it could be the real estate, and the real estate could be let to go in disrepair, or the real estate actually gets into an area that starts to get blighted and they don't move fast enough and it goes down. One of the great things about holding life insurance is it's a protection against the erosion of the wealth. So it gets passed on to the next generation. And if that next generation messes up the sequence by doing something wrong, by actually harvesting the cash value and putting it into businesses, or taking trips and just trying to blow the money, as long as it's in a trust where they have limited access to it, and as long as it was stated that they need to have life insurance on them, then when they pass away, they can fill the bucket back up for the next generation. And that is very, very important for people to understand. This is almost foolproof if it's set up properly at the beginning, because you're always going to fill the bucket back up.
And Bruce, I think when you say fill the bucket back up, I think it's important to note that what you mean is that the death benefit is always at any point in the policy higher than the cash value. So even if somebody had, let's just say they had $500,000 of cash value, but maybe that was I don't know, a $4 million death benefit. At that point in time that maybe they did take a maximum policy loan, right, Bruce? They're taking this maximum loan. even if they didn't pay it back, or the underlying reason that they took the loan, you're saying maybe was a failed business, or it was a real
Right.
estate investment that didn't turn out, there's still a huge distance between the top of the cash value, the cap, the ceiling of the cash value that they could have borrowed against, and the death benefit. Now, as you get closer and closer to age 120, which I say to every single person I talk to, and I'll just broadcast to every single listener that will ever hear this podcast, we hope that you live to age 120. But statistically, we know that most people don't actually live that full time frame until 121 that the life insurance company has set the date that you will expire on. And so at age 121, the cash value and death benefit would be equal in terms of their value. The cash value rises to meet the death benefit. And Bruce, you're also saying a rising death benefit is on the basis of a properly designed policy that was set up correctly in the beginning, that has it set up usually to have your dividends by additional paid up additions. Complicated language that if you're not familiar with life insurance, you don't need to understand all of that. What is really important is for you to recognize that you need to work with somebody who has the long-term vision in mind, that sets up your policy in a way that you do have this rising death benefit over time with guarantees, so that you have the ability to do, Bruce, exactly what you're saying, have that leveraged up death benefit. Every single dollar you've put into the policy will be the death benefit will be far greater than the dollars that you placed in terms of premium all along the way. And that leveraged up death benefit, Bruce, is then what you're saying is going to pay into the next generation to be able to reset everything and be able to start again to fund additional policies. And what you're saying is that even if somebody waited till they were, let's just say 85, and now they've taken maximum policy loans, so their cash value is much higher, closer to the death benefit at that point. They've taken maximum policy loans, there's still this space between the cash value and the death benefit, that all of that is going to pay into the next generation, with the death benefit paying into the family to then be able to be used. And I'm hearing as well, when you're saying properly structured, you can have trusts that surround the cash value and direct how that money is used in a way that you then can direct and specify you want that to be used to buy additional life insurance premiums, or to buy additional policies by putting more money into the premiums. And what's really important about this is to note that you have the ability to not just put money into a life insurance policy today, but then also continue expanding your family banking system and family banking strategy by adding additional policies on parents. You can add policies on grandparents. You can add parent policies on children. Your children can buy policies on themselves. And as you think about the whole family unit of people who are using an infinite banking concept, and they're all becoming their own banker, and they're in a position of controlling capital, you can think of that cash value of all of those policies as in this reservoir, or this network of cash within within the family. And then as you have policies that are expiring, you have the death benefit paying into the pool of cash to purchase additional policies, or to pay back loans that have been taken out on additional policies. So you have money that's continually coming in as generations are expiring. And so it gets more and more advantageous the longer it's been in operation. Doug Lodmell had said, when we talked to him about having asset protection in your family, that it's like cement. It continues to
Pardon.
solidify
Right.
for years and years and years. So you have an initial set time, maybe even 24 hours, where something is considered industrially strong enough to be able to withstand whatever building, I don't know, parking garages or skyscrapers or whatever you're building that you're putting concrete in, but it continues to harden over time for decades and for even centuries. It keeps getting harder and harder. That means it's getting stronger and stronger. The same way that life insurance that's used in a family, the longer it's used, the more decades, the more centuries, the more generations that life insurance has been able to be used in a family in this way, the stronger and stronger this fortress, this war chest of capital is for the family.
Yeah, and Joe DeFazio was asking about, do you mean delaying loans? I'm thinking what he was talking about, you know, can a life insurance yes, they can delay loans, taking distributions. Um, More than likely, yeah, taking distributions, cash, surrendering their policy, yes, all of those. Of course, Joe, it also would depend on the insurance company, but mostly would depend upon the Department of Insurance of that particular state and their rules and regulations. Also, I want to go back. Warren also he's a wealth of knowledge. He does also say they hold surplus assets in addition to required reserves so as to guarantee the death benefits. And we try to stay agnostic on the show as far as which insurance companies we use, and we do use several. We have our favorites, but and one of the favorites we use actually has assets over 14% of reserves, and the top 10 stock companies. I don't have it on the mutual companies, but the top 10 stock companies only average 7%. So they actually have twice as much in reserve. That bothers some people because they're like, well, maybe they could pay higher dividends if they didn't hold so much in reserve. We actually appreciate that because we do not think that rates of return actually matter. We actually we actually believe that rates of returns and surpluses are going to go up, they're going to go down over a time period. We don't know what those time periods are, just like everything else is going to go up and go down. But if they can be rock solid for you throughout their history, that's what's most important. So, um, there's a variety of other things we can go into other shows that you can do with if you have property structured, and we prefer whole life, but there are other high net worth individuals that use universal life. That's not what we consider the infinite banking concept. We would do not endorse that. However, for high net worth estate planning, there is a reason why you may use universal life rather than whole life. And I just want to make that very clear in case some people say, well, that's not infinite banking or that's not true. High net worth people use universal life. And that is true. They use a combination of both in a lot of situations. And the reason that high net worth individuals would use more universal life is because the guarantees aren't quite as rock solid. The guarantees are there, but the guarantee of the premium is not necessarily there. Where whole life, the guarantee of the premium not to go up is definitely there. So, Rachel, we can go into a lot of the other things and a lot of other episodes of how it enhances you with your other investments, so on and so forth, and actually allows you to spend more of your other investments because your spouse is going to get a bucket filled back up with the death benefit. I mean, there's all kinds of advantages.
Bruce, I think this has been a really eye-opening and insightful show, especially for somebody who maybe is new to the idea of using banking as a tool for storing family capital, being able to use family capital and build continually growing wealth in future generations. So I want to just provide some resources if you want to continue to learn about this. Certainly we have the podcast and we have a whole history of about 7 years of content that you can go back and listen to. So you can subscribe to the Money Advantage podcast. You can go ahead and subscribe here on YouTube, or you can we're on all the podcast channels as well, so you can do that. But I really want to tell you about our Family Banking Formula Bundle, which is a course and training that allows you to really have all of the training that you need to understand family banking and how to use it. And so this includes a workbook on how to utilize family banking, not just to set it up and get it running, but how to understand the loan process of taking loans and distributing loans and having them repaid in your family, but also setting up guidelines for what kinds of loans you want to be able to approve in your family and under what circumstances you would supply that loan and how you would want certain kinds of loans to be repaid. So it really helped you think through your philosophy of money in terms of how you want to manage the growing cash value inside of your family banking system. So this family banking formula does that. It also has an infinite banking course along with a family banking course. So we tell you about family banking, how and why you'd want to use that, and you understand that concept. And then there's a little bit more deep dive on infinite banking and understanding what that is and how to understand the nuances and how to understand how to make it work for you. So I want to tell you that you can get 50%, actually it's a little more than 50% off of that family banking formula if you go through buying our book. So the book is Seven Generations Legacy. My copy is all marked up here. But this is how to design a multi-generational legacy of more than money. You can get this book in a digital and audio format and a whole bunch of bonuses if you go to sevengenerationslegacy.com. Go ahead and get the book. It's $4.99. You get a ton of resources, and within that same process, you're going to be offered 50% off of the Family Banking Formula course so that you will be able to have that family banking formula and the infinite banking strategy. Now, what I also want to tell you, all things considered, if you're ready to move forward right now, you do not have to go through the process of getting a course and reading a book and doing all that. If you know that you want to take action today, go ahead and go to themoneyadvantage.com, book a call with our advisor team, and get started with the conversation to find out how you can start using family banking in your life today. We'll talk to you about your financial picture. We'll talk to you about exactly what a best funding strategy and recommendations are for you today, whether you're starting your first policy, whether you're adding a 19th policy, whether you have current policies, you want understanding on how to use them, or you are just getting started for the first time. We'd love to be a part of your journey. So with that being said, we're going to close out the show. Thank you for being with us today. And in closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.